Hey, welcome back to Everyday Economics. It's the podcast that helps you learn about the economic world happening around you every day. I'm your host, Chris Krug, CEO of the 501c3 nonprofit, nonpartisan Franklin News Foundation. Everyday Economics is a production of America's Talking Network, and you can check out all of our podcasts at americastalking.com. To support Everyday Economics, please make a tax-deductible charitable contribution by clicking the link in the show description. We're recording this episode on Friday, January 3rd, 2025, our first episode of the new year. And joining me as always, my friend and colleague, Dr. Orphe Divounguy. He's a PhD economist, an all-around good guy. Dr. O, Happy New Year. It's great to be with
Happy
you.
New Year, my friend, and Happy New Year to all our listeners. Thanks for making it this far with us, and let's do this again in 2025.
Yeah, it's been a lot of fun, and we've been doing this now. This is, I believe, 4 calendar years over the course of the last 4 calendar years that we've been doing Everyday Economics. We have a good time doing it. Every Monday at thecentersquare.com and across the Center Square Newswire service, Dr. O writes a column about the week to come in the economy here in the United States. And Dr. O, what's on your list for the first full week of the first new year that we have to talk about today?
Well, I mean, let's start with acknowledging that the U.S. economy is still looks pretty good, but is slowing, right? And I think that's important. It's important to say, hey, we're in a good place, but we're slowing, and the momentum is still negative. I think a lot of people look at the 1 month of data and think, oh my goodness, inflation's reheating. Oh my goodness, employment growth is increasing. No, the U.S. economy is still slowing. The momentum is still negative. We're going to hear next week from, this week, we're going to hear this week from Christopher Waller, Governor Waller. I think Governor Waller is the smartest person in the room always. And so it's going to be very interesting to pay attention, and I will be paying closely attention to his comments. He's likely going to discuss the state of the U.S. economy, inflation, the labor market, and what it means for Fed policy going forward. And so, we remember we just got off this another rate cut in December, and we said on this podcast that we believe this might be the last cut for a little while. The Fed is going to have to contend with noisy data at the start of this year. And you take the noisy data, you take the fact that we had a couple of hot inflation prints back in November and even December. And by hot, I'm talking about the CPI. The PCE is still moving in the right direction. Core inflation's been somewhat stuck, right? And you take those, you take that, and you have a Fed that's going to want to wait. It's a data-dependent Fed that's going to have to want to wait to see further progress on inflation, but also a Fed that doesn't want to see further deterioration in the labor market. The Fed really hinted that it's more concerned about the labor market by basically what it did is it changed the summary of economic projections to reflect basically, or at least to suggest that it would be ready to cut further if the labor market softened even just a little, right? So that's that. So we'll get what else we're going to get? We get an ISM. The ISM is going to come out. The services index will be out next week, and what it does is it measures activity in the services sector, so business activity in the services sector. The manufacturing sector still in contraction territory for a long time now, 2 years, at least 2 years now, 3 years. Services sector still in expansion territory, but again slowing at a slow pace, I guess, not fast enough maybe for some people. I like it. The reason I like it is because it keeps the labor market, it keeps the U.S. economy humming. This U.S. economy is basically a service, service economy. We'll have the job openings report, but that's for November, so it's a look in the rearview mirror. But we'll
Mm-hmm.
still pay attention because it helps us to figure out, what's going on in the labor market. Again, I still think that even though job openings increased in October, it doesn't mean they're going to continue to increase relative to the number of unemployed. Remember, if we have too many job openings relative to the number of workers that are available to fill those jobs, you have a labor shortage, right? And that labor shortage means higher wage growth, and higher wage growth tends to worry people that it could be inflationary. And I only say worry people that it could be inflationary because if you have strong productivity growth, then higher wage growth doesn't necessarily mean uh, potential price growth, right? So
Hey,
anyway,
yeah,
yeah,
Dr. O, while we were talking, or while you were talking and I was listening and everybody else was listening too, I got a bulletin that came through Market Watch um, regarding manufacturers' orders. So the ISM manufacturing index climbed to a 9-month high of 49.3%. Apparently, manufacturers received a bunch of orders here
yeah,
at the end of the fourth quarter. That just came
yeah.
out from Market Watch as we were taping this show.
That's right.
So
That's right. That's right. It came out this morning. It's a small increase, but still it's higher than expected, but still in contraction territory, right? So a
yeah,
reading below 50 means you're still contracting. You're basically contracting at a slower pace,
right,
which is a good thing. What we don't want is the sector to keep dipping faster and faster, right? So I think that's good news that basically the floor is not falling from under us in the
right.
manufacturing
Well,
sector.
the best in 9 months. So I mean,
Exactly.
yes, the number's not fantastic.
And
It's
some and some people might say, well, look at that, and they might point to this number and say, look at that, there's a big recovery coming back in the goods sector, and that big recovery coupled with a strong services sector, who knows, economic activity could be too strong and may not be able to keep up, and I say no, actually. um, when you think about what's inflationary, it's the difference between nominal GDP and real GDP. It's the difference between, you could even go a step further. It's the difference between GDP and potential GDP. How much can we supply? How much can we actually build widgets? How fast can we build widgets to keep up with demand? Is the way you need to think about what's inflationary. Uh, and right now we got strong productivity growth, and strong productivity growth means there's enough. There's a lot of there's a big enough increase in productivity that supply is closing in on demand, right? And so that's a positive. We need to, of course, continue to see more workers, right? So having employment growing fast is a positive. It means real GDP is increasing. Having the number of available workers, the population growing fast, helps us increase our potential economic capacity. And so and I only say that because there's a lot of conversation about, of course, policies that were, immigration policies, et cetera, et cetera. But again, we need employment to continue to increase, right?
right.
And so when people look at the employment report next week, which is the last thing I wanted to talk about, they shouldn't be concerned that employment is rising. Employment rising is a positive thing. It's good news. It means more people are working, more people are finding jobs, more people are basically filling those job openings that were still out there vacant. And that's a good thing for the US economy. So I always lose my mind when I see people panic and they see a strong employment number and they're like, "Oh my goodness, that means the economy is growing too fast. We're not going to get some rate cuts." No, it's a positive. We should welcome strong employment numbers, and hopefully we're going to get some strong employment numbers on next week, next Friday. I think, however, though, that the change is going to ease. It's going to continue to get lower and lower, right? As we progress through the year, especially if interest rates remain as elevated as they have.
Yeah. Well, I appreciate your thoughts as always, Dr. O. For Orphe Divounguy, this has been Chris Krug. Subscribe to Everyday Economics. and dozens of terrific podcasts at americastalking.com.